Wow, we have a packed house this afternoon, so I'll apologize in advance. If I say something that is so crazy American that it makes absolutely no sense in any language you know, just raise your hand and I'll try and translate. But before getting started, I should thank Sander. I should thank both Sanders. They made it very easy on me because they have the same name. They've done such a tremendous job in welcoming me here in Brussels, this beautiful city. I brought the Texas weather with me. The sun's been shining since I got here, and it is truly a lovely place filled with lovely, very interesting people, and the dinner last night was absolutely extraordinary. We sat outside in a garden. In any event, thank you very much for having me. Now, before getting started, and usually I don't have any candidates, but I suspect that I do have one or two today. Are there any former, or should I say reformed, central bankers in the audience? If you could show... Oh, this of course, this I knew in advance. Okay, so we have one. I just want to be sure, because what I'm about to say, it doesn't always go over so well with my former counterparts. I'm not exactly welcome back in the halls of the Federal Reserve. A little bit of background. As Sandra mentioned, I followed Richard Fisher into the Dallas Federal Reserve after he was named president of that bank. The world at the time was on the cusp of the great financial crisis. He and I were birds of a feather in one critical sense. We didn't have PhDs in economics, and it's not that there's anything necessarily wrong with having a PhD in economics, but rather we were both people with financial markets backgrounds, and that's the prism through which we saw the world. And we were both compelled to serve our country. We both came from much different lucrative type, Wall Street type careers, but made the decision to be part of our central bank. Now, Richard, suffice it to say, did not fit in with the academics, nor did I. Perhaps it had something to do with our ability to seasonally adjust our way of thinking. Now, if you're not familiar with the idea of seasonal adjustment, I'll share a little joke with you that a friend of mine once said at the podium. He happens to be very vertically challenged. I can look down at him, and he has no hair. And he once remarked of himself that if you seasonally adjusted him, he would actually be George Clooney. So I laugh to this day when I think back about that. And I see the economists who are laughing harder. You're identified. Okay, there we go. My friend's self-deprecation triggered a bit of introspection on my part. I exited my post as a central banker in the summer of 2015. I had weathered the storm of the financial crisis from the inside, and I had plenty of scars to show for it. And yet, as one CNBC anchored mentioned days after I left the Fed, I didn't look anything like any central banker he'd ever seen. Now, his off-the-cuff remark, which was not well received by his superiors at the network, helped open my eyes to the obvious. And that's that I would never be perceived as a central banker. Now, that was especially the case when I was on the inside looking out. But then I didn't join the Fed to become a central banker per se. That would have meant having had a preset agenda before I walked through the front door of the institution I came to know as being one of the most political in the United States. In time, I discovered that politics and hubris stopped the Fed from using the financial crisis as a good reason to reinvent itself, to look in the mirror. That opportunity, I'm sad to report, was squandered. The outrage it provoked in me became a book. I'm proud to report that Fed Up has been a raging success. It went to 22 worldwide on Amazon. My mother tells that to strangers in the grocery store. But that means two things. One, I will never get another holiday card from anybody inside the Fed. And two, and curiously, I've become public enemy #1 for the conspiracy theorists out there, the ones who have always imagined the Fed to be a secretive order of bankers set out to destroy the world in a very extraordinarily parallel universe in which most of our names theoretically end with Rothschild. And the only store of value on planet Earth is physical gold, hopefully buried somewhere. It's not. In reality, the Fed is a much quieter, even genteel institution, controlled by a silent majority of academics who have largely been trained in the same school of thought. The Fed's leaders get along in the most civil way imaginable, and therein lies the problem, because the Fed is so very powerful. In fact, I've come to refer to this cabal of unelected officials as the fourth branch of the United States government. The problem is what's missing, and that would be the checks and balances that America's founders put in place to make sure that not one branch of the government attained too much power over we, the people. Now, one of the reasons that I ended up as fed up as I am is that the overly intrusive actions of those who were appointed to shepherd our financial system since Alan Greenspan took office on August the 11th, 1987, has taken a grave toll on our economic well-being, and it's not a grave toll that is contained just to the United States. How so? Well, in a normal market, markets function as price discovery mechanisms. Let me share a story with you to illustrate. Hopefully it's a fun story. Now, as any woman in the world will tell you, there is nothing as delightful as being on the receiving end of a perfect robin's egg blue gift box, the iconic representation of Tiffany's jewelers. As it so happens, a story about Charles Louis Tiffany and J.P. Morgan, the banker, has proved immensely valuable in explaining just how financial markets are supposed to operate to my 4 children. Now, being the astute jeweler that he was, Mr. Tiffany knew that Mr. Morgan had an acute affinity for diamond stick pins. One day, Tiffany came across a particularly unusual and extraordinarily beautiful stick pin. As was the custom of the day, he sent a man around to Morgan's office with the stick pin elegantly wrapped in a robin's egg blue gift box with the following note. My dear Mr. Morgan, knowing your exceptional taste in stick pins, I have sent this rare and exquisite piece for your consideration. Due to its rarity, it is priced at $5,000. If you choose to accept it, please send a man to my offices tomorrow with your check for $5,000. If you choose not to accept, you may send your man back with the pin. So the next day, the Morgan man arrived at Tiffany's with the same box, in a new wrapping, and a different envelope. In that envelope was a note which read, Dear Mr. Tiffany, the pin is truly magnificent. The price of $5,000 may be a bit rich. I have enclosed a check for $4,000. If you choose to accept, send my man back with the box. If not, send back the check and he will leave the box with you. Tiffany stared at the check for several minutes. It was indeed a great deal of money, yet he was sure the pin was worth $5,000. Finally, he said to the man, You may return the check to Mr. Morgan. My price was firm. And so the man took the check and placed the gift wrap box on Tiffany's desk. Tiffany sat for a minute thinking of the check that he had returned, and then he unwrapped the box to remove the stick pin. When he opened the box, he found not the stick pin, but rather a check from Morgan for $5,000 and a note with a single sentence. Just checking the price. Yes. See, my American humor, it works. Yay! Just checking the price. That, my friends, that is how financial markets are meant to operate in their natural state. Today, though, we trade in the dark. We've done so since 1987. Now, that year may stick in some of your minds for 2 good reasons. A, the stock market crashed. But B, and much more importantly, as they say in Texas, where I'm from, there was a new sheriff in town, one Alan Greenspan. He had just been named chairman of the Federal Reserve. He would eventually come to be referred to simply as the maestro for the magical way he had of suspending the business cycle. And more importantly, the way he created mountains of wealth, a skill he passed down to his 2 successors. Well, how did that all begin? Well, there's a little story there as well, but it does not involve the 19th of October, Black Monday, as you might think. Now, on that day, Alan Greenspan was aboard a flight going from Washington, D.C., as it so happens, to Dallas, Texas. While he was in the air, he was headed there to deliver a keynote speech at a prestigious economics conference. While he was in the air, the stock market crashed, unbeknownst to him. This is before we had go-go in the sky. The minute he landed, a very nervous, frazzled Dallas Federal Reserve employee rushed at him with one of those brick phones and said somebody from DC was on the phone. They said, "Sir, the Dow Jones Industrial Average lost 508 points in one trading session, a near 23% loss, one that remains to this day the worst in US history." Alan Greenspan never made it to that podium. The first thing the next morning, he was on another plane headed back to Washington, D.C. to do damage control. He directed the Fed to release a statement that said the following: "The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system." He was not kidding. In the weeks and months that followed, Greenspan would go so far. I hope you don't lose what I'm about to explain. In the weeks and months that followed, Greenspan would go so far as to allow those on the New York Fed's market desk to leak information to Wall Street bond trading desks ahead of Fed moves to inject liquidity into the system. In Wall Street parlance, he'd invited those who profit the most to front-run the Fed. Front-running the Fed. As the years went by, Greenspan would eventually impose his will on the financial markets. 1994 was quite the year. We had the double whammy of Mexico's tequila crisis in the currency market and Orange County, California's bankruptcy. Both were met with emergency measures. This was followed in 1998 with the implosion of long-term capital management, an academic-run hedge fund that threatened to unleash systemic risk across the global financial system. All of these effective rescues led to the sustainability of the most overvalued stock market in US history, one that collapsed under its own weight in March 2000. Now, as a rookie on Wall Street in 1996, the very same year Greenspan called out investors' irrational exuberance, I can tell you that not even really knowing what the Fed was, they still managed to give new meaning to the invisible hand, unleashing untold levels of moral hazard as investors became increasingly brazen speculators, knowing their risk of loss would be contained if something went wrong. The Fed had their back. And I will never forget raising my hand at the first firm I worked at, Donaldson, Lufkin, and Jenrette, which, as I mentioned last night at dinner, was a much more interesting place to work before Credit Suisse bought us out. That's another story. Don't ever work for the Swiss. Anyways. I'll never forget raising my hand in a meeting, kind of like this, and asking our in-house equity analyst why he refused to lower his price target on a company by the name of Enron, despite the energy firm's clear lack of an ability to generate a profit. Well, the simple answer is that the analyst knew something I did not, and that's that his back was covered as long as the music was still playing, as Chuck Prince famously said. That is, of course, until Enron blew up. And he was right. Wall Street made a ton of money on the speculative deals all the way up until the firm declared bankruptcy. And that's just one example. The bottom line is Wall Street knew that it would always win. Wall Street knows today that it will always win. That might be about to change, which we'll get to in a minute. And Wall Street never did seem to care about taking Main Street down in the process. All the while, price discovery got slowly ravaged. Today, we all wear beer goggles, making everything appear to be more rosy than it is. Does anybody know what beer goggles is? No, those are beer. We've got one in the back who knows what beer goggles are. Beer goggles, this was a term that a friend shared with me, and then I, in turn, shared it with Richard Fisher. And when the Wall Street Journal assessed his career, his 10 years as a central banker, the beer goggles speech was the most famous. Sometimes he would modify it and have it be wine goggles, sometimes margarita goggles. But the point of it is, right before they're getting ready to call last call at the pub, at the bar, if you've maybe been overserved by an ambitious bartender, all of a sudden you have kind of a hazy look about you. And everything looks a little bit better than it actually is. People even look more attractive than they actually are. So these are beer goggles, and that's the prism through which we wake up every day and trade investments in the United States. Know that it all began with the birth of the Greenspan put on October the 20th, not the 19th, 1987. A put I should define as a security that's by its very design places a floor underneath investors' losses. In the roller coaster years that followed, Greenspan would again pull out all stops to prevent creative destruction from taking hold. I hope I sounded Austrian for a minute there. The Fed's extraordinary exertions, of course, fed the inflation of the housing bubble, which eventually led to the great financial crisis and the Fed's subsequent reaction. That reaction, of course, refers to taking interest rates to the zero bound, followed by executing quantitative easing over and over again. They also happen to define the years that I was on the inside at the Fed. Now, the $24 trillion in paper wealth created and largely destroyed by the housing boom has long since been displaced by over $40 trillion in paper gains that have been generated since the US stock market bottomed in March 2009. Now, you may note that I'm using the term paper to describe investors' gains. That's intentional. Paper, by its very nature, is very combustible. Now, what do these two eras, separated by a decade, have in common? Well, in a word, valuations. No matter how you measure valuations, asset prices have run wild. As was the case in the years preceding the last crisis, sadly, asset price inflation is absent from most of the inflation metrics the Fed tracks. That makes it very difficult for those inside the Fed, with a few exceptions, to recognize that commercial real estate has never been as overvalued as it is today, and it is very much a global phenomena. Prices have long since pierced their prior peaks. As for bonds, at nearly $250 trillion, the size of the global credit market dwarfs that of the global stock markets. Moreover, the growth of the debt has been extraordinary since 2007, contrary to any notion that we've just lived through a period of beautiful deleveraging. It hasn't happened. The question is whether holding bonds is being adequately rewarded. Last year, a group of London-based Deutsche Bank analysts looked back to the year 1800. What they found was that bonds have never been as overvalued as they are today, at least for the past 120 years. Now, you can take that statement and put it on steroids when it comes to the bond market here in Europe. We've never seen overvaluation. The overvaluation in the US bond market pales in comparison to the situation you have here. It is a tinderbox. It is what we talk most about in the United States, by the way, is what is the next potential mistake and where could it come from? And the answer is increasingly the European bond market. As for the stock market, well, you tell me. Should we be worried about stock market valuations? Clearly, we've had a few wake-up calls in the past few months. Well, the answer is actually yes and no. If we're in the latter stages of a late 1990s style rally, well then no, we don't have any reason to stress. The rally could go on for a few more years, even though it's already the second longest in the history of the United States. But if you're not comforted knowing that stocks are more overvalued than at any time since the dot-com boom, at least as gauged by the size of the stock market to the size of the US economy, well then yes, you should be worried. You should be very worried. and stock markets are global as well. April of this year marked the second longest economic expansion in U.S. history. You have to ask yourself the question, what exactly is going to keep the U.S. economy chugging along, moving forward? 3 more hurricanes and 2 more wildfires that generate another $300 billion in insurance proceeds, an all-time annual record? Perhaps the Trump administration can push through more fiscal stimulus that will have to be financed with debt. Or is it as simple as yet another wave of share buybacks to prop up the stock market? Though blasphemy to some, maybe it is time to rely less on financial engineering and more on investments that produce a lasting return. Maybe it wouldn't be such a bad thing to ask the central bankers of the world, who have assumed more power than any politician, to step aside, to let the business cycle go back to being cyclical. If they did, they might realize how much they're asking of retirees who can no longer afford to be prudent in their investment allocations. Consider that at the current rate of return on cash in the United States, retirees there would have to have $10 million set aside to earn just enough in annual income to stay above the poverty line, which is $16,000. My parents don't have $10 million. Of course, there is a flip side. There has to be a flip side to the lowest savings rates on record. And that is the lowest borrowing costs in the past 5,000 years. Now, I'm not going to fact check Merrill Lynch's math, but they say it's 5,000 years. I'll take their word for it. At least Uncle Sam has benefited from the Fed's misguided policy that's punished savers, right? One would hope. One thing is for sure, the United States counterparts definitely got the memo. Governments from Austria to the United Kingdom to Switzerland, and even Canada to the north, and Mexico to the south. They've all issued 50-year and 100-year bonds. A year ago, Argentina issued a 100-year bond. Argentina, I would remind you, is sporting 40% overnight rates. But can you blame these governments? Of course not. But the question becomes one of, where's the United States been? Now, Federal Reserve officials have known that foreign buyers of our debt cannot be dependent upon indefinitely, the Chinese, the Japanese. It follows that Fed officials also know that their country's politicians have squandered a perfectly good opportunity to indemnify the nation's balance sheet in the event of a future crisis by extending out the maturities of our treasuries. One of the saddest graphs I can look at is that of Great Britain, where they have reduced dramatically the average maturity of sterling, I just forgot the word for, thank you. Gilts, thank you. But they've reduced their sovereign debt maturity tremendously, and we've gone in exactly the opposite direction in the United States. We've actually reduced it. I said that backwards. The United Kingdom has extended, we've reduced. Anyways, strangely enough, the United States Treasury has been conspicuous in its absence from the ultra-long bond market, even as our government's debt has exploded to $21 trillion and counting, and I mean counting. The United States accumulates $250,000 of debt every single minute of every single day. Debt is projected to hit $25 trillion by next year. Strangely enough, the first lesson drilled into my head on day one at the Fed was the only thing that matters is the cost to service the debt. To that end, the country paid about 2% to service its debts in the years preceding Trump's election, despite outstanding debt having tripled. Can you imagine how very compromised the United States would be if the Fed did manage to normalize interest rates, which it has not yet done? This past February, the deficit hit the highest level since 2012, and we know that that's just a hint of what's to come, given the spending plans. Meanwhile, interest paid on marketable securities was up 10% just over the last year. It's going to keep growing. As for U.S. households, Their debt loads are back at record highs, and delinquencies have already become problematic. There was a news story out today about car delinquencies. Delinquencies have already become problematic for car and student loans, for credit cards, and even some government-backed mortgages. I would remind you that the United States is still technically an expanding economy. We don't normally see these rates unless we're already in recession. But that's what happens when the one-trick pony that is Fed policy is deployed over and over again. Our collective predicament is what happens when a country tries to borrow its way to prosperity. These are the things that keep me up at night. They even anger me. Spineless politicians have benefited handsomely thanks to the Fed playing along. But make no mistake, the citizens of the United States will ultimately pay the price. Now, most Americans would concur that it's high time that those in Congress started earning their salaries and doing right by their constituents. I hope you too now can appreciate that it's well past time the Federal Reserve stopped enabling congressional misfeasance, as we call it, and in doing so, restore the financial markets to their proper function as price discovery mechanisms. After all, uninhibited price discovery is the bedrock of every free market economy. Living within our means, saving those hard-earned dollars, sacrificing today to ensure a better tomorrow, these are the disciplines that helped foster a superpower economy. But the fact remains, keeping interest rates lower for longer has ravaged those who dare save, while richly rewarding those engaged in reckless investment behavior. As inconvenient a message as it is to hear, the current QE era has outlasted its welcome. Policymakers may have intended to revive animal spirits by making debt so cheap for so long that it was impossible to not play along. But over 30 years later, in the wake of one speculative boom and collapse after another, I'm afraid to say we have not learned nearly enough. It is not the creation of debt that makes a lasting impact on economic prosperity. Rather, it is investment in the future that holds its value for generations to come. Ladies and gentlemen, we have to get back there, some way, somehow. That's why I wrote Fed Up. Not only does the book walk you through what's led the United States to this precarious position, but it provides a blueprint on how to get the country's economy back on more stable footing, not by ending, but by upending the Federal Reserve. The process of taking the Fed down to the studs and rebuilding it from the ground up starts with cutting its dual mandate in half. Reduce the Fed's mission to safeguarding the buying power of the United States dollar and return job creation to the private sector, where it belongs. And in times of need, emergency need, fiscal authorities. This will begin to rein in the mission creep that's corrupted the Fed. Now, in the event you think that I'm being too harsh, consider this. The United States is the only developed economy that has suffered 2 decades of a shrinking workforce. This is not a demographic story at all. It's a monetary policy gone wild. The Fed has been pushing on that proverbial string for a very long time. Next, redraw the lines of the Federal Reserve districts and deconcentrate the power base away from Washington, D.C., away from New York. The economy of 1913 may have justified 3 Federal Reserve banks in the Midwest, but things have changed since then. California is the largest economy in the country, followed by Texas and by New York in 3rd place. After you've redrawn the Fed's map, give all district presidents permanent votes on the Federal Open Market Committee. California and Texas do not cease to be the largest input to U.S. GDP every 3 years. So why should their presidents only be able to vote that often? It's ridiculous. Once this logical step is complete, ensure that you only install leaders to the Fed who conform to the original and still valid requirement that those in charge of our currency come from a diversity of industries. Never again allow those running the Fed to not be on the receiving end of the policies that they make. Institutionalizing what I call intellectual diversity will reintroduce dissent at the Fed and make sure that the word no is never again a bad word. This will in turn ensure that policymakers at the Fed have the wisdom and the insights to know that it's the Fed's job to take away the punch bowl just as the party gets going. Now, a lot of Americans have heard that punch bowl punchline. It is my favorite. But did you know that it was William McChesney Martin, my hero, and the longest-serving Fed chairman in its 100-year-plus history, who said it? The funny thing is, Martin was no PhD. He studied economics at Columbia University, but he didn't even earn a graduate degree, much less a doctorate. One thing he did understand, though, was markets. He got his start at a brokerage firm, followed by a post at the New York Stock Exchange just 2 years after the 1929 crash. His subsequent groundbreaking work at the Securities and Exchange Commission reestablished confidence in the stock market and landed him the presidency of the New York Stock Exchange at the tender age of 31. Newspapers called him the boy wonder of Wall Street. But here's my favorite tidbit of Martin's wisdom, and I hope you understand it. Martin was also famous for warning politicians that they should always keep PhDs in economics on tap, close at hand, but never on top. That's my kind of street smarts. It's safe to say that Martin is spinning in his grave today as an army of 800 PhDs. We do not have enough in the country. We have to import them. 800 PhDs at the Fed monitor the economy. I understand it's a big economy, but please. If he were alive today, he would no doubt validate my recommendation to save taxpayers a lot of money by cutting the bureaucratic ranks of the Fed's academics at least in half. Now you see why I don't get holiday cards. Now, I'll take the streamlining argument one step further. Why not eliminate the alphabet soup of banking regulators down to perhaps one? For a case in point, I will refer to Chair Janet Yellen. On the very same day that one regulatory agency was closing down a large lender in what was then her San Francisco district, a bank by the name of IndyMac, her San Francisco Fed was trying to extend the broken bank a credit lifeline. Classic left hand not knowing what the right hand is doing. Now, with all the money that you've saved, hire the best banking regulators and supervisors that money can buy. Never again allow the fox into the henhouse. Bring in the brightest minds, those who can read even the most complicated bank balance sheet, maybe even Deutsche Bank's. That will make it that much harder for Wall Street to stay one step ahead of its regulators, as it always has. One last note. It might be wise to re-examine the inner workings of the world's most powerful and influential central bank more often than every 100 years. It's just a suggestion. Now, if more politicians had acted to keep the Fed independent and apolitical, as it is supposed to be, we wouldn't be in the pickle that we're in today. That's a technical term. With corporate, household, government, all three debts are at unprecedented levels, and every financial market around the world at nosebleed valuations. As for the price that we'll pay for this fleeting moment, global central banks have amassed over $22 trillion on their balance sheets. That equates to nearly half of global GDP. Never forget that this point of return did have a starting point. On December the 14th, 2008, Fed policymakers voted to take interest rates to the so-called zero bound, a move that unleashed quantitative easing and the biggest experiment in monetary policy history, one that continues to this day. You shared a scene from the end of Fed Up. I'll share a scene from the beginning of Fed Up related to this day. Were there voices of dissent to be heard in that conference room on that day? Did anyone argue for the little guy, for the cautious investor? Did someone in the room speak on behalf of pension fund managers now forced to take undue risks? What about the leadership of firms and big banks whose incentives are perverted to the extent that they no longer invest in their country's future? The short answer is yes. I worked for one of those who pushed back against the majority. He was the lone member of the FOMC who voted against the professor's theories on that fateful day. He fought the good but lonely fight, and I, in my capacity as his trusted advisor, waged many a battle with him. But the sad truth is we lost the people's war. In a world rendered unsafe by banks that were too big to fail, we came to understand that the Fed was simply too big to fight. Now, I'm happy to report that this stark conclusion may be in the process of changing. There may be reason for hope, to express optimism. And it all comes down, for the moment, to one man, the first to lead the Fed in over 30 years whose peers do not refer to him as doctor. What makes Jay Powell unique to me is a brief conversation that I had with Richard Fisher in the fall of 2015, just months after the two of us had left the Fed. Richard said, Danielle, I want you to pay attention to one person, and only one person on that committee, one whose eyes have been on shrinking the balance sheet for longer than anyone there. His name is Jay Powell. Follow him. Again, that conversation took place nearly 3 years ago. All I knew about Jay Powell at the time was that he was independently wealthy after having spent years in private equity, so theoretically he doesn't need the Fed's pension. He was a lawyer by training, and he had once worked for $1, for a $1 salary, to educate the Congress on the perils of the United States defaulting on its debt. In the years that follow, Powell gave me very little to build on Richard's endorsement. He was blessedly quiet compared to many of his peers on the FOMC who've never seen a podium they didn't want to jump behind. The faith I had in Richard's judgment led me to cheer for Powell when his name was among those being considered to lead the Fed last year. In exchange for that blind faith, I was finally rewarded when the 2012 FOMC transcripts were released early this year with their traditional and ridiculous 5-year lag. 2012 was Powell's first year at the Fed, and I was relieved to read that he spoke in plain English. Here's a very small sampling, we'll finish this up, of his simple and clear logic in his words. On the subject of the Fed's misleading and puzzling communication, Powell worried that it was, quote, confusing to people who spend fewer than 50 hours a week on monetary policy, that is, most of the public. On theoreticians using mathematical models to make policy, Powell spoke of his peers in private equity and in the hedge fund world, who were, quote, willing to put more than just an opinion on the line. On the tricky practice of unemployment rate and inflation rate targeting, Powell was rightly concerned that Fed policymakers would, quote, own them once we put them out there. Boy, did we own them. He was right. The Fed damaged its credibility, lowering the unemployment rate target on multiple occasions, effectively moving the goalposts. On shrinking the Fed's mammoth balance sheet, Powell was concerned that the Fed had accumulated so much of the market, Mario Draghi, do you hear me? That the Fed had accumulated so much of the market that when the time came, quote, to even stop buying, the response could be quite strong, and not in a good way. I think he's right. On quantitative easing, Powell said that for very modest benefits, we were piling up risks for the future that could be habit-forming. Indeed, they've become habit-forming, like a bad drug. And finally, on the dangers of Fed policy, in words that central bankers worldwide should heed. These words from Jay Powell, quote, we are actually at a point of encouraging risk-taking, and that should give us pause. Investors really do understand now that we will be there to prevent serious losses. It is not that it is easy for them to make money, but that they have every incentive to take more risk, and they're doing so. Meanwhile, we look like we're blowing a fixed income duration bubble right across the credit spectrum, and that will result in big losses when rates come up down the road. You could almost say that it was our strategy. Think about how long ago he said that. With any luck, that strategy is about to change. With even more luck, the Fed's global central banking peers will follow in its footsteps in taking action to divorce monetary policy from financial markets functionality. I do so hope you will join me in a hearty hear, hear. Anybody?
Hear, hear.
Thank you. The alternative, a continued faith in overly intrusive monetary policy that has long since done more harm than good, must be abandoned once and for all. Now, I would normally say that in the best tradition of central bankers, I'll avoid any of your questions, but we'll get to that later after we have our fine panelists speak to us. Thank you very much for your attention.